All right. Hey, everybody, and welcome back to our monthly market update, the July edition. I'm Brad Gatto, owner and founder of Fiat Wealth Management. And here, as always, with me is Mr. Tim Holland, the Chief Investment Officer of Town Square Orion. Tim, thanks for joining us right before the holidays.
Yeah, no, really good to see you, Brad. Halfway through 2024, right? Officially in the back
Yep,
half. Crazy.
which always seems nuts.
Yeah,
It
it goes
always
by
seems to go really fast.
so fast. But no, it's good to be with you, and hope you guys have a wonderful fourth. You got big plans for the holiday?
Well, evidently not as good as yours, because if you can't tell, my background is my normal background, and yours is not.
No.
You've already relocated for the holidays, but we're sticking around as we record this. It's July 2nd. I think this is the earliest we've ever gotten to be
I,
able to record in a month, which is great.
I think so.
Um, I live in a small town in outside the Twin Cities called Delano, and this is what they're known for is the 4th of July.
Really?
It's like one of those small towns that just goes absolutely all out. It's
Oh,
bonkers.
that's
So
awesome.
they have a full week-long carnival. There's basketball games going on, softball games going on. There's a car show. There's a parade. There's the fireworks. I mean, you name it. It's all happening in this little town. So we like to stick around and take advantage of what they call the Delano days. So we're
Yeah.
just going to be doing that and enjoying that. How about you?
No, that sounds awesome. Yeah, to your earlier comments, we're down the shore. So, we live outside of Philadelphia. Jersey Shore is about an hour and a half away. So we've decamped to a town called Avalon for the week. So
Decamp. I
Meredith,
like that word.
yeah, sounds fancier way of saying we drove then we drove to Avalon. But no, down here with Meredith and the kids, and as we were talking about earlier, half of our hometown like shifts to the Jersey Shore this week. So they're out and
Sure.
about. They're buddies, and they're having a great time. And maybe a little interesting Jersey Shore fact. Jersey Girl, Bruce Springsteen, that song from 30, 40
Yep.
years ago was actually written by Tom Waits. One of the few songs that Bruce ever recorded that he didn't
Huh.
take pen to paper on. And again, given he's such an icon of the great state of New Jersey, kind of interesting that he didn't write that. It was written by Tom Waits.
I had no idea. Like
That's
I
all
didn't
I
even know
got.
that he was known for writing most of his music. I knew none of that. So that's all. You learn something new every day, right? My
Yeah, that's
brain
all I
just
got.
expanded. So I appreciate that. Now let's try
Yeah.
to teach everybody a little bit of something about our kind of what's going on Wall Street in the markets. And so if this is your first ever monthly market update, we have 3 points. We look back at the month prior. I'll look ahead to the month that's coming up, and then just kind of a data point worth discussing. And so we're going to start with a look back, and I'm naming this point when the tide rises, which of course is kind of half of the story. It's that old saying of when the tide rises, all boats go up. And the reason I want to talk about that is because if you look at your portfolios, anybody listening to this, I would hope they're up. Like just although if you're in a diversified portfolio in any meaningful way, your portfolio should be up on the year. What percentage, of course, is going to depend on what exactly you're invested in, but any good diversified portfolio should be up. The question isn't that. If you look one layer deeper than the overall value of your portfolio, one of the things you might have noticed, and I know people are paying attention to this because we get a lot of questions on it, is certain parts of my portfolio are kicking butt. It's a very professional term, right? And then other parts of my portfolio, not as much. And so we're beginning the questions of why am I invested in some of this other stuff? And so can we just talk, Tim, a little bit about what the S&P is on the positive side, what the S&P is doing, which
Yeah.
is the majority of a lot of people's portfolios, large American companies, versus some of these other segments of the market and why they're lagging behind.
Yeah, no, it's a great question. So for the month of June, the S&P was up 4% or so. The NASDAQ Composite, which is home to all those great large cap US tech companies, the NVIDIAs of the world. So is the S&P, but the NASDAQ Composite is particularly sort of tech heavy. That was up about 6%. And so year to date, the S&P is up about 15 and the NASDAQ is up 18. And those two very strong rates of return have been driven overwhelmingly by those 6 or 7 mega cap tech companies, the NVIDIAs of the world, Meta, the old Facebook, Microsoft, and the like. And they're all fantastic companies. And it's kind of neat that, these world beating companies are all US companies. So,
Yep.
the whole AI revolution that's been driving a lot of the revenue and earnings growth for those companies, and a lot of the excitement and enthusiasm for them as investments is something that the U.S. is at the forefront of. So good for us, right? From an economic perspective, I think long term. And then to your point, say the Russell 2000, which is the benchmark for U.S. small cap stocks, is up a little bit year to date. It struggled last month. And then the MSCI EAFE index, which is a collection of companies from developed international markets. So think France and Germany and Japan, also struggled last month. Now it's also up year to date, sort of low single digits, but nowhere near what the S&P 500 has done and what the composite has done. And so, as to your point, as you sort of look deeper into a portfolio, you'll see subsets of the equity universe doing better or doing worse. And the reason we think you want exposure to smaller companies and mid-cap companies and some well-run companies outside the US is, one, they offer good value. They haven't done as well. So you're not thrilled about that, but the upside is they're much more attractively priced than most parts of the market. And a lot of academic research shows that blending a portfolio on the equity side of using large, mid, small, and some ex-US exposure, though we have a bias towards the US, over time gives you a still compelling rate of return and mitigates risk, mitigates volatility, and mitigates drawdown potential, and allows you, again, to sort of compound over time with less volatility, less risk. And the beauty of that, we think, is ultimately that keeps all of us invested in the market, letting time and compounding work on our behalf, as opposed to running too concentrated of a portfolio. When it works, it's great, but opens you up to much more meaningful downside risk, volatility, and the odds. And we've seen this professionally. We've been in this business a long time, you and I, of people getting spooked and shaken out of the market at the worst possible time, for sure.
Yeah, it's always easy to say and hard to do. You should buy low and sell high. Makes perfect logical sense. The problem is the spreadsheet very rarely matches our rational behavior. But looking at it, I do want to pull up a quick chart. I don't want to make this video longer than it needs to be, but I'm going to share my screen really quick. So if you're watching this versus just listening to it, we can put it in the show notes as well. This is what I call it a quilt chart. The Callan Institute has put this out for years and years. This is one of the first charts I ever saw getting in this industry almost 20 years ago. So it looked a little different when I got in, but it's just a 20-year look back. And if I just scroll down to the next page, it's just going to show you, it's just looking at all these indices that you and I talk about all the time. So we've got, the S&P on the large cap side, the Russell 2000 for small cap. We're also looking at these developed, non-US companies, emerging markets, non-developed, non-US companies, where, fixed income, cash is in there, all that kind of stuff, real estate even. And just looking at it year over year, which asset class is performing the best and which is performing the worst. And if you can't see this and you're just listening, the reason I call it a quilt chart is because it looks like a quilt. There's no rhyme or reason. Every asset class is a different color, and there's no rhyme or reason to where the colors end up. So just extreme example for the last 2 years, the worst performing asset class last year, 2023, was cash, and it still did 5%, which is unbelievable. The year prior to that, 2022, the best performing asset class was cash, and it did 1.46%. But some of the biggest questions we're getting, Tim, are in that small and mid-cap space. And so when we look at the portion of the clients' portfolios that are in small-sized companies, which, correct me if I'm wrong here, because I haven't looked this up in a while, a small company isn't like, me. That's not what we're talking about. We're talking about small, publicly traded companies, which have a market capitalization of, what, 2 to 10 billion, something like that?
Yeah, no, as the market continues to go up more than it goes down over time, what was small cap 30 years ago is now sort of a bit bigger today than it was then. But to your point, most folks would consider a small cap company in that 2 to 10 billion dollar range. And I think the median market cap for the Russell 2000, which again is the benchmark for US small cap stocks, is in that low single digit billion-dollar range. So these are publicly traded companies, right? They're filing financial statements with the SEC. They're followed on Wall Street by research analysts. They have investment bankers that work with them as well. But there are several billion dollars in equity value for sure.
Yeah. Well, and just looking at it, like I'll just pick on the non-US companies, whether it's the smaller non-developed or it's the highly developed, like you mentioned before, like France and Germany and places like that.
Yeah.
Both of those on this chart are orange, dark orange and light orange. And if you look at them recently, they're at best kind of middle of the chart, whereas you back up to the early 2000s and they're dominating. They're
Yeah.
at the top of the chart for quite a while, quite a good run. And without getting into the specific numbers, it just points to this idea. And Callan's whole chart is kind of building that case for strong diversification, not just diversifying inside of like having 50 different large cap companies,
Yeah.
but also diversifying outside of just large companies, getting into mid and small companies that perform differently during different economic environments versus companies, located outside of the United States. And so it's just one of those deals where looking at a portfolio in the very short term, like this year, or even into last year or the last couple of years, would lead you to believe that international positions are just not the place to be, and the whole portfolio should be invested domestically. And so when we look back at like this month, it's a microcosm of kind of this bigger picture we've been looking at for the last couple of years. And so I just wanted to bring it up and make sure that people understand that there's a rhyme and reason to this, right? There's a plan behind it. And if you want to copy that Callan chart, all you got to do is look it up. It's all public information. Callen is how you spell Callan. Again, they put it out every year. Kind of gives us a good barometer. So anything you want to add to that before we go to a look ahead?
The one thing I would add back to the Callan chart, if you look at small cap stocks, which have struggled, and we think the reason they've struggled is bond yields have remained elevated, interest rates are high. And we've talked about this before, smaller companies tend to be much more dependent on short-term sources of capital, lines of credit, and the like. Whereas if you're a mega cap company, you've got a big balance sheet, you can sell bonds that are not going to mature for 15 years, put that money in the bank and you're good. So, if yields continue to come in fits and starts, if the Fed is cutting rates later this year, that should prove a much more constructive environment for small cap stocks. But I would note that over the last 10 years, even with their struggles of late, there were 3 out of those 10 calendar years where small cap equities were the best performing asset class on that Callan chart. So that's just worth keeping in mind, I think.
Yeah, no, great point. Awesome. So a look ahead. I'm calling this point, is there pain on Main? Main being Main Street in my title here. And what I want to look at is we're starting to see data around kind of the average consumer, you and I, Main Street data of struggles.
Yeah.
And what I mean by that is some of the data that you've got listed here in our look ahead is credit cards and auto loan charge-offs have already spiked. In other words, charge-offs, at least as I understand it, I want to make sure that I'm reading this right, is the default, people that just aren't paying their bills. And so when you look at the average consumer spend as relative to their income, when you look at debt write-downs through credit cards or just the increase in credit card debt or auto loan debt and people that aren't being able to pay those bills, what does that mean for you and I? Why should we care?
Yeah, no, it's something we've been paying a lot of attention to. The New York Fed, right? As you know, the Federal Reserve is made up of a series of regional banks. And one of the neat things about the regional banks is if you look at the folks on staff, they're all these just brilliant economists, the Cleveland Fed, the New York Fed. And the New York Fed just produced some really interesting research on credit card charge-offs and auto loan charge-offs, essentially meaning that those loans are going bad, to your point, and the banks are just writing them off. They're assuming they're not going to get paid back. And you've seen a meaningful move up across the entire sort of U.S. consumer cohort, but a very pronounced spike among lower income consumers. You're at a level of sort of credit cards not being paid off and auto loans not being paid on a regular basis that we haven't seen since 2008 and 2009. And so the big banks report earnings for Q2 in a couple of weeks, JP Morgan, Bank of America. So we're going to be paying a lot of attention to what they're saying about the U.S. consumer, because it seems to us that at least at the lower socioeconomic rung, you're already seeing a lot of pain. And I think if the job market starts to wobble, that's just going to get a bit worse, because if people have a paycheck coming in, they can sort of meet those bills. So we just think that you're seeing weakness in the consumer. I think it's getting worse, not better. I think I don't think we're in for a ton of economic pain, but I think it's kind of a canary in the coal mine that there's stress on Main Street. And it
Yep.
all makes it more likely that as we get to the back half of the year, the Fed will be cutting rates in a way to sort of lower borrowing costs and try and support a big chunk of the consumer that I think is already feeling a lot of pain. Conversely, that environment of lower rates, lower bond yields can still mean good times on Wall Street, even if it speaks to a backdrop on Main Street that's increasingly challenged.
Yeah. You brought it up a little bit, and I don't want to like touch on it a lot. I want to give our listeners a little bit of a break from the Fed because I feel like it's all we've talked about.
I know.
They do not have another meeting until the end of this month. And so I'm sure we're going to talk about it again in August, because if you've listened every month, at the beginning of the year, the Fed and Wall Street weren't in cahoots as far as rate cuts are concerned. Coming into the year, Wall Street was at 6 cuts, the Fed was at 3. Now here we stand today, and the Fed is at 1 and Wall Street's at 2 as far as assumed rate cuts coming. All that being said, obviously something like this and Main Street kind of starting to suffer a bit is something that could signal a decrease in rates for us. So pros and cons, right? It's, from a positive side, from a rate perspective, and the rates continuing to stay high. Again, in my almost 20 years in this industry, I've never had a better time of finding income for retirees off of a portfolio than I have right now. So there are positives to some of this stuff staying high as long as it has. We've been kind of, not chicken littling people into this idea of hurry up and get into these bond portfolios so we can get you some income before it goes away. But saying with a little bit of urgency, hey, look, we don't know how long it's going to last. So take it while you can get it. And so far, that run has gone on probably a little longer than most people expected coming into the year. So how about a data point worth discussing? I'm going to call this point, it's a birthday is worth celebrating. Okay. And so the birthday that we're talking about here is for the bull, which is the good news. I have to ask you, I'm an Iowa boy. Okay. I grew up near farms. My family is not farmers. Okay. But I've got family members that are. Do you know the difference between, bull, cow, and any other term, heifer, that you've heard?
Little bit, but I'm from Trenton, New Jersey, so I grew up in a row home playing two-hand touch football between parked cars. So yeah, I'm probably not an expert on any of that.
Yeah, it's not this. Yeah, most people aren't, so don't feel bad.
All right, good. I appreciate that.
But I wanted to name it something with cow, and I was like, it's just I can't do it because it's not the same thing. Most people wouldn't pick up on it and wouldn't care. But a bull is a male, and a cow is a female. So anyway, the birthday that we're celebrating is the bull birthday. In other words, we hit a bull market. Talk to me a little bit about the definition of a bull market, and then when the birthday hit and why it's actually worth celebrating.
Sure. And this is kind of neat, right? Because it's July 4th, America's birthday, right? So all this kind of coincides.
Yeah, absolutely.
So, a bull market is generally considered to be in effect when a major index like the S&P 500 rises 20% from its low. And so you're in a new bull market. So if you're up 10 or 15% off that low, it's not considered a new bull market. Once you hit 20%, you're in the bull market has started. A bear market is the inverse. It's typically considered to be when a major index like the S&P 500 declines 20% peak to trough. And then a correction is typically thought of as a pullback of 10%. So you can have corrections of 10 or 11% and still be in a bull market. You could also be in a bear market and have the stock market rally meaningfully, but it's, again, not enough to start a new bull market. So 20% on the upside is a new bull market. We entered a new bull market June of last year, right? The market bottomed October of 2022. Seems like a long time ago. Rallied in fits and starts. So it was up over 20% in June of 2023. So we just celebrated the first anniversary of the current bull market. The neat thing is, right, if history's any guide, knock on wood, we're up 50 some odd percent from the October 2022 lows. Bull markets tend to run 3 to 4 times as long as a bear market. A typical bear market usually is 12 to 18 months. Typical bull market, if you go back decades, usually 3 to 4 years. So
Yeah.
it may be hard for people to believe, considering how well stocks have done, especially big US companies of late. But if history is any guide, we've got another couple years of a bull market, broadly speaking, for the S&P 500. And what should happen, and this gets back to the beginning of our conversation, is as that bull market proceeds, you should see greater participation down the cap spectrum, some smaller companies starting to join in the fun and the festivities. But that's what we, why we wrote about it in this month's letter, because we celebrated that birthday last month.
Yeah, really good stuff. So again, doesn't mean it's guaranteed that that's what's going to happen. Again, we're just kind of looking at it from a historical perspective. And to your point, it also doesn't mean it's going to be a straight upride.
No.
Because inside of a bull market, you can have 10+% pullbacks and have that not by definition ruin the fact that we're still in a bull market.
Yep.
So doesn't mean that there isn't going to be some sort of pain or some sort of anxiety during that run. But again, with history as a guide, we've got 3 good years in front of us. And I hope it's true. It's a birthday I will continue to celebrate with you. Hopefully we're still talking about this time next year. Speaking of birthdays, let's see if you can do the math in your head. It's 2024. We're celebrating America's birthday. How old are we as a country?
I wanted to throw out 248 rings a bell.
That's exactly right. 1776 to 2024. We got 250 coming up in a couple of years. I wonder what
so cool.
What America's going to do.
Cool. we are the longest live democracy on the face of the earth, right?
Yeah.
I mean, people think Western Europe and France and those were monarchies. They went through terrible internal stress and tension and often conflict and civil war. And so again, for all the problems we have, all the challenges we have, we are the world's longest live democracy, and I still think the last best hope of this big blue marble we're all living on, for sure.
the big blue marble.
The big blue marble.
I like it. Well, Tim, I appreciate your insights as always. Enjoy your 4th of July. Celebrate that birthday with your family. Hopefully it means some good times for y'all.
For sure.
Enjoy the Jersey Shore. I'm going to enjoy little Delano, Minnesota, and have a good time there. And look forward to seeing you in August.
Me too. Great seeing you, Brad.
Good, Tim.